The break-even interest rate is the maximum interest rate that could be paid on the debt before the leverage becomes unfavorable. So remember we said that positive leverage is when the internal rate of return on the property is greater than the return on the debt. And so the break-even interest rate is that basically tipping point before we get to a situation where it is unfavorable. And so our break-even interest rate is calculated as our ATIRR, after-tax internal rate of return, sub P. So the after-tax internal rate of return on the property divided by 1 minus T, or 1 minus the tax rate. So for example, if we have a before-tax IRR of 7% and an after-tax IRR of 4.82% with a 35% tax rate, our break-even interest rate would be 7.42%. So that means that for interest rates that are higher than 7.42%, the after-tax IRR for an equity investor, so the ATIRR sub E, would be less than the after-tax IRR on the total investment. So ATIRR sub E would be less than ATIRR sub P, which was our 4.82%. And then the opposite means that for interest rates below that 7.42% break-even interest rate, the ATIRRE would be greater than the ATIRR sub P. Now, as the amount of debt increases, lenders may charge a higher interest rate to obtain additional financing. So remember, there's an incremental cost of debt, which means that the actual cost of additional financing may be a little bit higher, or at least needs to be addressed separately.